Omar Najia, Global Head of Derivatives of BB Energy. Omar, markets open a little bit up, trying to get back to that $70. What is your takeaway from last week of the movements we saw there and your outlook for the coming days?
So look, I think, oil took out that 65, or WTI took out that 65 high, which I think is a big deal, which means basically that the fall from 65 is not, or the rise up to 65 is not corrected, but a new kind of push to the upside. So I think we get to mid-70s. I think we get to mid-70s, into maybe, I think this move will continue, and will continue now, as opposed to kind of, go back down, then come, next 5 weeks, say 74, 76 WTI, something like that. And I like the rest of the markets as well, including the S&P. If you look at NASDAQ, I was looking at all these, Apple, and I was looking at Tesla, and they all look like they were kind of, really putting in like bearish patterns. But I'm kind of changing my mind about those. So maybe the NASDAQ is going to kind of, get a second kind of wind to the upside. So all in all, I think I'm pretty positive across the board.
Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, all the numbers seem to be starting to, within the US, be quite positive. We have in our digest today, US gasoline demand last week pretty much got back to year-ago levels. More and more people are flying, it seems, every week now, climbing up towards 1.4 million barrels, 1.4 million people in airplanes every day, and $1,400 paychecks coming in the post. What's there not to like about President Biden?
Well, so far so good. I mean, it's nice getting those $1,400 paychecks, and as I think Omar described very well earlier, we're having a pretty good everything rally in everything, except including bond yields, but not bond prices. But I think the key part of it is in terms of crude oil, it's the least bullish of the whole space. Partly because it has to depend on these cuts from OPEC, how long they'll last. It has to depend on demand coming back. And one thing I've sensed is I'm actually in Florida this week. I've traveled here, driving around. We flew. But I don't think we're going to get back to the kind of demand we had before because of this flexible work schedule. And I really sense that at work. Most people are just like, okay, maybe I'll work 2 days a week. Right now, they're not even in the office. So those people, the average person who got in a car and drove 50 miles a day, it's just not going to happen. And then, of course,
I saw on New York, sorry, Mike, to interrupt, is 10% of office workers are in offices in Manhattan.
If that. And our office is 5%. So I appreciate the mention, because that's definitely what happened. But it's the human nature that I'm sensing, that these people are not coming back unless they have to. And now they know this is a major paradigm shift. They don't really have to. They can do flexible. Maybe I'll come in 2-3 days a week.
Where's the ramifications of that for energy demand, do you think? I mean, we're seeing gasoline back at normal levels, air travel climbing, and probably will continue to climb in the context of the US market. Besides commercial real estate investors, what's the consequence of people not going back to their offices?
Well, we're just not going to have that kind of demand. Sure, it's spurting back right now, but we're not going to have the kind of demand that was incrementally increasing before. And a key thing to remember is U.S. demand for liquid fuels and crude oils is exactly the same it was in 2004. So that massive innovation and efficiency is just starting to kick in with the Biden administration. It's just getting started.
The other issue I suppose we have to touch on to try and get some sobering cynicism back into this conversation, Bora Bariman, managing partner of Hormuz Straits Partnership. Not that is your role today, but amongst all this bullish talk, I'm always drawn to a story that says U.S. companies face a record of $10.5 trillion debt bubble. Interest rates won't have to move very far, Bora, for this party to get a good slap in the face.
Well, you're right. Let's take it back to the headlines from the UK over the weekend. Was the collapse of Greensill, one of these asset management firms who took on sort of the branding of fintech or alternative banker, right? Alternative bank. But at the end of the day, they were borrowing money and lending money, right? And they had a lot of support from the coronavirus lending scheme of the government. So they had about £1 billion of UK taxpayer support, much in the way of the liquidity schemes that you see around the EU and the United States. And unfortunately, for some reason related to backing unsustainable business models, they're unable to service their debts. And I would keep my eye open for those types of developments in the years ahead around the world, right? There has been a lot of easy money that has been chasing the idea of remaking the world, remaking banking as we know it, remaking shopping as we know it, remaking dining as we know it. But these are all very much high risk venture capital type risks. I don't know that they are bankable risks to be remaking the world. So like any type of VC type risk, you would see a lot of volatility around that. But again, when you mix high leverage and volatility, you hit insolvency.
You hit insolvency. Omar, the other factors in terms of China, again, China looking very positive, data coming out overnight. China's factory output surges as recovery there accelerates to near record levels. Throughput on refineries in China very solid through January and February. Does this market still need China as much as it did? And what's your outlook for the support that the Asia demand continues to deliver to the oil price? You're on mute, Omar. Sorry.
So we've had the same thing for at least 10 years, right? So incremental demand growth comes from the East. That's not going to change. So like Mike was saying, US demand, if you like, is pretty quote unquote static, same with Europe. So everything's coming from the East and will continue simply because, emerging economies, growing economies, etc. So that's not going to change. Also on the point of, people working from home and all the rest of it, the US is last in terms of recovering from COVID. So it started in the East, then it'll come to Europe, then it'll come to the States, right? So in China, or the East, people are back at work. In the Middle East, I remember from ourselves, before we were working like at 50%, blah, blah, blah. Now everybody's back. Working from home is great, but after a while, it gets like really kind of, annoying because you need to see, other people, colleagues, all the rest of it. So I think, some of that, I don't know how much, but some of that definitely will impact the US. So if 5% of people are back now, then I think given between now and the summer, maybe that increases basically.
And if we're already at $70 on Brent and not far behind on WTI, we still have 5 million barrels a day of demand recovery coming pretty soon, according to the IEA. These prices could keep moving rather significantly, or are we already overcooking it?
No, we're going to go. I think we're going to go higher, but I think basically it's not demand. It's not like you count this and you count that, and therefore the price has to go higher. I think basically what's going to happen is you're going to get a dislocation between demand coming and basically supply in everything, not just in oil, but supply not being able to meet it. Supply of airline places, supply of restaurant seats, because people laid off their staff, or 80% of them, or 50% of them. So everything is kind of, everybody's kind of destocked. Also to do with oil, because the backwardation stuff has come out. So nobody's going to restock unless they see, or unless they actually physically see the whites of the eyes of demand. So there's going to be a dislocation there. I think that's going to be the last kind of push to the upside. And again, it's important to realize what we're talking about now is a bullish oil market. It's not going to go on forever, but I think it'll go on into 2022, something like that, another year. etc. Then, we come off, then we go up, then we come off, and all this kind of stuff. But for the moment, I think, the expectation is things improve, liquidity improves, risk appetite increases from the incredible, nutty levels that we're at, etc. The alternative, and there's always an alternative view, is that it all comes crumbling down, and we have like a zombie apocalypse and all the rest of it. And I just can't get my head around that.
That's just a JLT. That's just a JLT. Mike, meanwhile, back at the ranch, inflation has its relevance, and of course, it seems that we've got a battle going on between the Fed dismissing it and the market saying, no, this is something to pay attention to. What do you think of the outlook for that divergence, and how significant is it?
Short term, we might have a little bit more of this inflationary factor, but in the big picture, the Fed is starting to figure out this is one of the most significant deflationary periods in history. Number one, because of innovation. So the way I like to describe it is people are bullish,
which is a pre-COVID trend, right?
Exactly. It's just accelerating now because of COVID. And this is a big picture thing. I mean, we can easily, the average cost of shale in this country is now almost the lowest ever. It's why? Because of technology. We have solar panels. I drive an electric car. This is just accelerating. That's a key point that Kathy Wood makes a lot. And so I think what's happening is in the short term, yes, but these higher oil prices are just going to incentivize more supply, incentivize more EVs, and it's just starting to accelerate. So that to me is, and then you look at the estimates like people like McKinsey in America, just an estimated 20 to 30 million people will be displaced into more of this gig economy by 2030. It's happening, it's accelerating. And just those old days of unions being able to push up wages and things are gone. So I'm very much in the deflationary camp. Yes, you have to keep printing money. And this is just mainly happening because of massive increase in it's suddenly part of gradually and suddenly.
Is there any narrative Mike, in the US, where we're already seeing in Europe, in the UK as a lead, that taxation, the austerity, who's paying for this stimulus? Is there any conversation in the US where that starts? Or is that just a non-starter?
Well, that's a key thing, in fact. But we can look at massively increasing debt to GDP and QE. You were getting a pickup in yields and everything. But what's been the trend in yields has been down for 40 years. Yes, this is a pickup in the trend, but the big picture is down. I think it's going to continue lower. The Fed's going to keep printing money, but the minute we get a little bit of reversion in the stock market, that's massively deflationary, particularly for crude oil.
Is there appetite, Mike, in the US for another stimulus? I mean, the story's already pouring out about infrastructure.
There's one key thing that'll happen to make that happen, Sean: stock market going down. Right now, everything's fine. But if the stock market goes down, they'll just prime the pump. This is almost a guarantee.
Bora, meanwhile, in Europe, obviously the UK is having a significant recovery in the context of its vaccination program. What is the outlook for that versus the rest of Europe participating in the same recovery that we're seeing in the US, we're seeing in Asia for a while now, but Europe still seems to be laggard behind. Is there a way for Europe to catch up on this?
Well, I'm sure there is. I don't want, again, it's not going to be zombie apocalypse. I'm with Omar on that. It's a supply chain issue in Europe, as I understand it. They've got to get around to distributing the vaccine, as other major countries have been able to do, and I can't see that there's any fundamental reason in Europe why they can't get their minds around it. But there's a little bit of more political debate, or I don't know if it's regulatory debate, about this vaccine versus the efficacy of another vaccine. So clearly, they need to get around that, and there will be major political pressure to achieve that, because on the fundamental level, people want to get out, and people want to consume, as they are doing in the US, as they're doing in Israel, as they're doing in any other developed country that is getting a grip on the vaccination issue. But you mentioned about inflation and paying for this. Well, I've just got my council tax bill here in London, and it's 6% higher than last year. So there is a sense here in the UK that the bill is going to be footed by someone, and we can see that very clearly. Who's getting the who's getting foot with the bill? You know, um,
And how soon, and the challenges we saw in the US, the sort of over the last week, that Biden is living the ghost of Christmas past, not having a big enough stimulus as 10 years ago and gone really big. And then in the UK, the sort of ghost of Christmas past being the austerity came too quickly and was too severe. So how do you navigate these return to normal? Omar, what kind of vulnerability do you think that is as policymakers face this challenge of return to normal? Of course, we're trading tomorrow's optimism, tomorrow's profit, but ultimately the ship has to be directed by policymakers and others as we come out of the dark forest. Is there a risk there, do you think, that the management of the transition to normal is mismanaged?
I don't know about other people, but if you look back, if you look at the UK, right, ever since you had somebody like Margaret Thatcher, who was basically a person that was doing, you know, rightly or wrongly, what she thought was good for the UK. All the people that we've had after are just, you know, getting worse and worse in terms of quality, worse and worse in terms of everything. I mean, some of them, you know, some of them are, I mean, it's terrible what's happening. So the quality of people leading countries politically is just going down the drain. So, I mean, you could look at the US.
So is that a yes then? I mean,
well,
in terms
I mean,
of the risk of mismanaging the transition to normal?
Big time. They don't. I mean, so many mistakes have been made, and no, you know, a lockdown, no lockdown, vaccines, masks, double masks, triple masks, wear the whole box on your face, all this kind of stuff. It's a bit ridiculous. Of course, these people have no idea, right? They have no idea what they're doing, and they have no public spirit. They're not doing it to help people. They're doing it for money. All of them, everywhere. It's not just, you know, the US, UK, Europe. All of them. Look at what happened in the, you know, the problems now in Germany with you know, the corruption there, the UK, the US. I mean, it's endemic. So yeah.
Well, we saw in Germany yesterday the results of two sort of elections, state elections that were seen as bellwethers for the general election in September, where two left-leaning parties beat Merkel's obviously right-leaning party at the polls yesterday. Could be a sign of what's to come there in terms of managing the exit. Let's get the view from the room on where this all goes next. In our poll this morning, where we're trying to establish what is a bigger threat to global economic growth in the coming 12 months. Which of these would you put your tick in the box to as we move forward? What happens? What is the biggest threat? Somebody takes away the punch bowl. Mike, your thoughts on that question and ultimately guiding markets going forward. We have the IEA report coming out this week on Wednesday, St. Patrick's Day, a good day to get some direction for the markets.
I think they're going to point out that what should continue is that demand revisions will remain disappointing. And it should continue on a global scale. We're just not getting that kind of demand. And what I fully expect the market's not anticipating yet is the amount of supply elasticity that's going to come out of the US. As soon as these prices, people are starting to hedge a lot. I can see it in the commercial hedging. And that's why it's going to just do exactly what it was doing before COVID. It's going to start coming back on. The US is going to be more of a net exporter, and OPEC's going to have a problem. They're doing the same thing they've been doing for the last 10 years. It really kicked in 2014. It had a little rally. So I don't see what's changed other than cost of production's lower and they're hedging more. So to me, the bigger picture for crude oil is not great. That's why as a commodity guy, I always shift over back to the metals. I can see pretty good demand and appreciation in metals, not the petroleum.
Bora, are we at the risk here of, buy the rumor, sell the news? I mean, the optimism going into this coming out of this dark forest is so massive that the new dawn is going to have to deliver literally trumpets and bells on every street corner. That the second half of the year can only but disappoint from a market's point of view, but maybe from a Main Street point of view, actually deliver some positive. But from a market's point of view, it would have to be a massive delivery. I mean, on oil alone, we're talking 5+ million barrels of demand recovery. That's got to start pretty soon, and it's going to have to be 7 or 8 or 9 million barrels because we haven't had any growth so far.
We've priced in too much optimism. It's clear.
Bora?
I think this stimulus is due, and I think it's appropriate, and it covers, for example, in the U.S., 85% of Americans. And let's look at the qualification. You need to have an income up to 75,000 or 150,000 per couple, and you get 1,400 per person, plus another 1,400 for each dependent. They're having their cash infusion, the checks in the mail, or it's already cleared the account, and these people will have a high propensity to spend and consume in the real economy, which is, I think, a goods economy. Even if it's a service, meaning eating out, it means food moving around, right? And this is an energy intensive economy. And I think this will continue to at least support the fundamentals of the market for oil as it stands today. But the biggest factor there is OPEC's restraint, right? And that is a political decision. If that's lifted, then it's a different ball game. But we have to remember, when you're talking about, the stock market, this is driven by the 15% who are not qualifying for the 85%, who are not in the 85% getting their stimulus checks, right? Those
What's
people
the wind down in the UK like? Getting out of this COVID stimulus period of paychecks for furloughed workers and all of that stuff. The wind down that's coming.
That's the thing. Again, the theme is, I'm saying the people who have been on these furlough schemes, that's a nice little thing that they're getting. But the people who are not getting those schemes have actually benefited because you've had your huge rally, right? The people who are not getting the checks in the mail, who are not qualifying for that because their incomes are too high, they've been driving this Bitcoin bubble, this stock market bubble.
Well, they're getting the credit loosening from the central banks.
They're getting the credit loosening. They're absolutely in a fine place. And if that is corrected down, so be it. I mean, we all expect a correction in the tech valuations. My son was very excited about Roblox being listed, and it has a 38 billion market cap now. You may have never heard of Roblox, but this little Lego.
All I know about Roblox is what the British Army used to put up whenever we wanted to go to Belfast.
It's Lego online, and it's worth more than ENI, which is pumping out however many million barrels per day. And how the UK plans to get out of this, it's a big question mark. But the plan is that we loosen and we never go back. That is the official position. So they're being tight on loosening the restrictions because the idea is it's like a ratchet. We're never going back. But that is a big question mark because
you're never going up. Maybe ultimately every mountain of debt that seems to me is a winner for Asia because inevitably it ends up somebody has to pay. Let's go to the answer of this survey question to get a sense from the room where things may be going. So COVID pandemic is still hanging in there as the biggest threat to global economic growth in the coming 12 months. I didn't give it my tick. I'm starting to think it's not. But Omar, your thoughts on that, and where do you think the markets are going in the more immediate sense to the week ahead now, Monday morning, a little bit of a bounce out of Asia?
Yeah, I mean, I don't want to kind of jinx anything, but, finished COVID. Something else will probably rear its ugly head But I think in kind
Well,
of
the question was the biggest threat to global economic growth, rather than it's not disappeared clearly, but
stimulus by far. Stimulus. I mean, you know,
that's what I voted for.
Central banks have been trying to inflate this economy since before 2008. So they've had, like, you know, I don't know how many years of trying to inflate, and everybody's always like, here it comes now, all the rest of it, blah, blah, blah. So what you have, I agree with Mike, is a kind of fear of inflation coming. But I think what's going to happen is you're not going to get this kind of inflation. You're going to get deflation simply because you have so much spare capacity in everything. And you have to have demand for these services and all the rest of it. And, you know, the US and Europe have become, financial economies, so to speak. So, you know, they're making money off interest rates and buying and selling and all this kind of stuff. So again, we come back to, buy Bitcoin and just
get
wait.
on and get on Elon Musk's first flight to Mars. Mike, your thoughts the week ahead? Clearly, the market's opening with a sort of continued sense of upward motion in the coming days.
Well, I don't really know so much about the whole week, but I think a key thing to think about for the big picture for deflation is look at U.S. natural gas. It's a benchmark future. It's one of the best measures and sources of electricity and heat on the planet, and it's still hovering at all-time lows near 2.7. In 2009, when the Fed first went to zero, it was $4. So there's not an OPEC restraining supply, but there's massive supply coming from innovation. One market I'm still bullish is Bitcoin. I think it's going to break out higher. And I look at a commodity super cycle. It's not happening in those old guard commodities, maybe metals, but it's happening in Bitcoin. Bitcoin's becoming the digital reserve asset in a world that's going digital. So I think market's picking up on that. And the more naysayers, the better. Just like when we first adopted electricity, it just takes a while for these things to kick in.
Well, there's a wrap on that. Thank you, everybody, for your insights today. Omar in Dubai, Bora in London, and Mike on the beaches of Florida, I hope, enjoying some of that nice Florida weather. And thank you, everybody, for joining us. Have a good week, and we'll catch up with you in the coming days. All the best. Thank you.
Thanks all.
Goodbye.
Bye-bye. Thank you.
Goodbye.